This hearing will now come to order. Welcome to the first hearing of the Subcommittee on Financial Institutions and Consumer Protection this year. This hearing is in a hybrid format. Our members are in person, but we will have witnesses testifying both in person and by video. We are grateful for their presence. For those joining remotely, just a few reminders. Once you start speaking, there will be a slight delay before you are displayed on the screen. To minimize background noise, please click the mute button until it is your turn to speak or ask questions. I guess I should practice that. You should all have one box on your screens labeled clock that will show how much time is remaining. As we are all here in person, our speaking order will be, as is traditional, that is by seniority of the members here when the gavel came down, and then by seniority of members arriving later, alternating between Democrats and Republicans. I'm honored to chair this subcommittee and to work with Ranking Member Tillis to ensure stability in our banks, our credit unions, and other financial institutions that serve families, small businesses, and communities in Georgia and around our country, and to ensure that our communities have equal access to the financial resources that build an economy that works for all Americans. Now that brings me to the topic of our hearing today, which will examine Community Development Financial Institutions, or Cdfis, and Minority Depository Institutions, or MDIs, and the role that they play in supporting communities, creating jobs, boosting our economy, and helping small businesses to thrive. We will also examine the roles they play to help communities build resiliency against a crisis like the pandemic, overcome crisis, and importantly, recover from the crisis so that our communities do not simply survive but thrive. Finally, I hope that our witnesses will discuss ways that Congress can better support the work that they do every day to grow our economy from the bottom up. The economic turbulence of the COVID-19 pandemic has pushed working families to the brink, often forcing them to choose between their health and their livelihoods. Thanks in part to the aid passed by the Congress to combat the pandemic, our nation is experiencing one of the quickest job market recoveries ever seen. Last month, the Georgia Department of Labor reported that the state's unemployment rate is now 2.6%, with 97% of jobs lost during the height of the pandemic now recovered. Last week, the jobs report showed that jobs rose by 467,000, defying the expectations of many experts. Critical in facilitating this recovery has been the work of Cdfis and MDIs. And I appreciate that we have two before us here today to talk about the work that they are doing even now in their respective communities. Let me say that this is also personal for me. This is not theoretical stuff. In addition to serving as a senator for Georgia, I'm also senior pastor of the historic Ebenezer Baptist Church, spiritual home of Martin Luther King Jr. and John Lewis. And the bank that our church uses, Citizens Trust Bank, is in fact one of the many Cdfis and MDIs in Georgia that have been helping families and institutions in our community to thrive. I know this firsthand. And as a pastor and as a senator, I see my work as grounded in serving others and my community. And that's why Cdfis and MDIs, that's what Cdfis and MDIs are doing. They're serving others and the community. Whether it has been acting as our nation's fiscal first responders, immediately there to assist families and small businesses facing the financial unknown during the first weeks of the pandemic, or facilitating the flow of federal aid to communities. Cdfis and MDIs provided economic stability and certainty to millions of Americans, allowing them to focus on the health and the safety of themselves and their children. In Georgia, the Atlanta-based Cdfi Access to Capital for Entrepreneurs, or ACE, immediately sprung to action early in the pandemic to help small businesses. In the first months of the pandemic, they worked with their clients to offer emergency funds, including Paycheck Protection Program loans. And they worked with local development authorities and investment partners to give flexibility for small business borrowers as the economy recovered. These actions by just one Cdfi saved hundreds of jobs in my home state of Georgia. The Federal Reserve Bank of San Francisco has rightly referred to Cdfis as economy shock absorbers for communities in the worst of the downturn. These institutions make sustainable investments within our communities. They are members of our community. They know the folks in the community. They understand these communities, and they have the correct incentives to help communities prepare, work through, and recover from the crisis. Cdfis are also helping communities protect themselves against climate disasters. In Georgia, Cdfis have collaborated to begin offering green loans, which is capital provided to small businesses in the state to help them have a business that is more eco-friendly, such as funding energy efficiency improvements. These investments help to create green jobs, and they push Georgia and our nation towards a sustainable future. Even with the work done by Cdfis and MDIs to help communities, the data show that we still have more work to do. In the crisis we are currently living through, there's no doubt that the jobs recovery, as strong as it is uneven. Men have entirely recovered their job losses since the pandemic began, while there are 1 million fewer women in the labor force than in February 2020. The recovery's been uneven. And unemployment among Black Americans remains elevated. And if history is any indicator, rural communities, like those in my home state of Georgia, will lose resources, and these same communities will struggle to bounce back as they see resources leave their communities. The number of MDIs fell by 31%. The number of minority depository institutions fell by 31% from 2008 to 2018, even as the need for these institutions remains higher than ever. And there are even those who wish to defund the Cdfi fund program permanently. I think that is wrong-headed, and I believe Congress and this subcommittee in particular has an important role to play to ensure that the financial institutions that support underserved communities, small businesses, and working families traditionally overlooked by larger banks have the resources, the tools, and the support to continue their important work. That is to ensure that ours is an economy and a capitalism that gives communities, all of our communities, a chance to thrive. And so this hearing is about helping people, it's about helping communities and helping small businesses. Hardworking American families are on the front line when a crisis strikes a community, whether it is a natural disaster made worse by global climate change, economic recession caused by greedy corporate business practices, or a public health crisis such as the ongoing COVID-19 pandemic. As families, small businesses, and communities recover, we must ensure they have the resources they need not only to survive, but to thrive. Thank you, and I will now turn to Ranking Member Tillis for his opening statement.
Thank you, Chairman Warnock, and thank you for holding this hearing. It's our second this Congress, first this year. I appreciate it. I also want to thank the witnesses for being here to testify. I've long been an advocate for a resilient and diverse banking ecosystem, one that blends a healthy mix of globally systemic financial institutions, super regionals, and regionals, all the way down to local community banks. Banks and credit unions of all different sizes bring varied missions and capabilities to their customers, allowing individuals to select the banking experience best tailored to them in their communities. I also agree that Cdfis and MDIs fit into that important ecosystem. And we only have to look at the experience in our response to the pandemic, when the financial institutions of various sizes mobilized to actually get desperately needed resources out to businesses through the Paycheck Protection Program. In total, the SBA approved over 1.8 million paycheck protection loans, totaling $799 billion in dollars. Cdfis, for their part, approved over 350,000 PPP loans, totaling $8.4 billion. I want to thank you all for the mobilization. And Chairman Warnock, I was struck by the fact that when we were mobilizing, having worked in the banking industry and a regulatory environment for a part of my career, that they were willing to mobilize when the rules were literally being written, when they were just putting facts out with the Treasurer. The fact that they were willing to do that, I think, is extraordinary. And I want to, in this setting, want to thank the Cdfis and the MDIs who also mobilized and answered the call. But that said, I've raised concerns in the previous subcommittee hearing over the lack of transparency, data and transparency that happen to be related to unemployment benefits. But I think the flooding of the zone of resources and various studies point to the fact that we can do a better job with transparency, accountability, and measuring efficacy in these programs so that people like me who believe in them will continue to support and sustain them. Policymakers simply do not receive enough information to adequately judge how effective lending operations of CDFIs are. Report from the Cusey Institute up in New Hampshire on behalf of the Department of Treasury said this: in developing this report, the research team encountered significant data limitations at every turn and identify inadequate data and non-standardized auditing practices as significant barriers to CDFIs achieving better capitalization. The authors go on to say it is currently simply impossible to make the most routine analysis that are normally conducted with other classes of loan assets. It is not possible, for example, to create a breakdown of default rates or prepayment speeds for a given class of CDFI loans, or even provide a breakdown of borrower or credit scores. What is ironic about this, I'm going on with the report, is that CDFI managers feel they are swamped with reporting requirements which they routinely fulfill. It's difficult to reconcile how CDFIs can be doing so much reporting and yet we have so little to show for it in terms of meaningful information for people like me who want to continue and build on these programs. And I mention it not to vilify CDFIs, but to point out that I believe there are systemic deficiencies in the CDFI oversight and transparency that can prevent them from most effectively serving the communities that they reside in. Given the tremendous level of funding bestowed on CDFIs and MDIs over the course of COVID-19, I believe these deficiencies are especially important to examine and rectify. Just last year, the CDFI fund received the same level of funding it would have previously been appropriated over a decade, a more than tenfold increase. Additionally, Congress established the Emergency Capital Investment Program, ECIP, which provided an additional $9 billion fund to help stabilize CDFIs and MDIs. My colleagues on the other side of the aisle also reinstated the Obama-era Small Business Credit Initiative, SSBIC, or BCI, in what was arguably partisan reconciliation package that they passed last year. This $10 billion program, which will also direct money towards CDFIs, was rightly allowed to expire due to chronic inadequacies that resulted in only 4 states whose SSBCI programs were in compliance, according to the Inspector General's report. And North Carolinians are familiar with the lack of oversight over taxpayer dollars that the SSBCI doled out. The founding president of the North Carolina Rural Center resigned and was withheld severance following a state audit which detailed financial malpractice at the organization. So without greater transparency and data requirements, I'm concerned we could see the same situation play out again. With a price tag in the tens of billions between SSBCI, ECIP, and the 12-fold increase to the Cdfi fund, it is crucial that policymakers are equipped with concrete data that provides an accurate view of the impact of Cdfis and MDIs. While a press release touting how much money went out the door is good, comprehensive data, greater transparency, a better understanding of efficacy is also very, very important. So, Mr. Chairman, I had a brief conversation with a member on the floor and briefly with the witness before us. I want to make it very clear that I think that Cdfis and MDIs are a critical part of a healthy ecosystem for of all financial institutions. We need to provide access to capital to unserved and underserved communities. But we also owe it to those same institutions to make sure that we're getting it right, that they are accountable, and we understand what programs are working and what programs are not. I look forward to the witness's testimony.
Thank you so very much, Ranking Member Tillis, for your opening statement. Now let's turn to our witnesses. Testifying today will be Mr. Robert James II. He is the president and the CEO of the Carver Financial Corporation. It is a Cdfi and an MDI from my home city of Savannah, Georgia. In fact, Carver State Bank is right down the street, literally right up the street from where I grew up. He's also the chairman of the National Bankers Association. Also testifying is Ms. Jeanne Cusey, president and CEO of Jetstream Federal Credit Union, Miami Lakes, Florida, on behalf of the National Association of Federally Insured Credit Unions. Jetstream was one of the first Cdfi credit unions in South Florida, and we're grateful to have Ms. Cusey here today. Finally, our last witness is Mr. Griffith, a research fellow at the Heritage Foundation, where he focuses on financial regulations. We appreciate your testimony, and we look forward to this important discussion. Mr. James, from Savannah, Georgia, God's country, I will now turn things over to you.
Thank you, Chairman Warnock, Ranking Member Tillis, and members of the subcommittee. Good afternoon, and I appreciate this opportunity to testify on how MDIs and Cdfis support communities. Again, my name is Robert James II, and I'm president of Carver Financial Corporation, which is the parent of Carver State Bank in Savannah, Georgia, and I'm chairman of the National Bankers Association. The NBA is the leading trade association for the country's MDIs. A critical part of our mission is to advocate for all MDIs on legislative and regulatory matters affecting our banks and the communities we serve. Like Carver, many of our members are also Cdfis with a primary mission to serve those who are underserved by traditional banks. Our banks are on the front lines trying to eliminate the racial wealth gap that makes our communities the most vulnerable during good times and bad. Decades of income disparity, unequal access to healthcare, and residential segregation have made communities of color and other low-income communities less resilient. The COVID-19 pandemic and climate crisis bring this inequity to light. Eliminating the racial wealth gap is not only the best way to combat environmental and health injustice and ensure resilience in communities of color, but recent research shows that eliminating this gap would add trillions of dollars to America's GDP. We believe our banks are best positioned to help our communities become more resilient in the face of climate change, health emergencies, and systemic issues that have placed them at an economic disadvantage. The Senate Banking Committee has taken concrete steps to ensure that MDIs and the communities we serve are not forgotten during times of crisis. For example, the Bipartisan ESIP program and increased funding for Cdfis can help many MDIs and Cdfis scale up and provide more access to capital in underserved communities. The Bipartisan Infrastructure Bill provides billions of targeted dollars that can be instrumental in addressing systemic environmental injustice while also providing new economic opportunities. The NBA looks forward to working with Congress on additional legislation to ensure that our communities, hardest hit by the pandemic and systemic inequity, experience lasting material changes. I want to highlight today the need for legislation that will allow MDIs to continue to augment our capital bases, push to include our banks and communities in opportunities that will flow from the infrastructure bill, and address a regulatory process that can hamper our bank's ability to bring the underserved into the financial mainstream. Traditionally, MDIs and Cdfis have served as anchor institutions in minority and low-income communities. Unfortunately, our smaller size, particularly among African American MDIs, has not allowed us to respond as quickly or with much scale as these situations demand. MDIs make up only 3% of all American banks, and Black-owned MDIs only 0.4%. When looking at total bank assets, the disparity is even more stark. As of the second quarter of 2021, Black banks held about $6 billion in total combined assets, as compared with over $22 trillion in total assets in the US banking system. Put another way, Black-owned banks only control 27 thousandths of 1% of total bank assets in the United States. We need more capital to scale. Tier 1 capital, or the equity invested in a bank, is the most critical component of our resilience, and it's what allows us to grow and scale. MDIs have historically lacked access to capital markets, limiting our scale and ability to invest to make our communities more resilient. The ESIP program is a historic step in the right direction, but unfortunately, many of our banks were not able to access it due to the uneven application of regulations that have failed to consider the unique business models mission-driven banks must employ to provide basic banking services in markets that are otherwise ignored by mainstream banks. We need regulators to be intentional and modernize an examination process for mission-driven banks that don't do business in wealthy areas. The Bipartisan Infrastructure Law presents a generational opportunity to not only prepare our nation's roads and bridges, but also to be inclusive. MBA members are eager to participate in the financing of major projects in our communities and to connect minority businesses to these opportunities, especially in new areas like EV charging. Intentionally including our banks and our customers will strengthen small businesses, create good jobs, and make our communities more resilient. The COVID-19 pandemic spurred us to start addressing the root causes of racial inequity and health outcomes, many of which revolve around economic disparity. It's time now to expand the conversation to address the economic roots of environmental injustice and ensure that all Americans are protected from the worst effects of climate change. In this regard, the NBA looks forward to working closely with the committee and subcommittee on workable solutions that ensure that under-resourced communities will not only survive, but ultimately thrive. Thank you for the opportunity to testify and for your efforts to ensure equity for all communities across the country. I'll be pleased to answer any questions.
Thank you so very much, Mr. James. Next, we will hear from Ms. Cusey, who will also testify virtually.
Well, good afternoon, Chairman Warnock, Ranking Member Tillis, and members of the subcommittee. My name is Jeanne Cusey, and I'm testifying today on behalf of NAFCU. I'm the CEO of Jetstream Federal Credit Union, a low-income Cdfi and MDI serving Miami-Dade County, Florida, and Puerto Rico. Credit unions are proud of the record of diversity in helping their communities. At the end of 2020, there were 520 MDI credit unions, and the number of Cdfi credit unions has been growing, with 416 at the end of 2021. As we continue the pandemic recovery, NAFCU urges Congress to consider increased funding levels for the Cdfi program. It is this program that gives credit unions like Jetstream an important resource to help create initiatives to serve our communities. At Jetstream, we are heavily vested in the prosperity of the communities we serve, having supported them through hurricanes, government shutdowns, and during the COVID-19 pandemic. Our membership is diverse and reflective of the communities that Jetstream serves. 71% of our members are classified as low income or below. 67.5% are Hispanic, and 18.8% are African American. Since 2011, Jetstream has received $5.8 million in Cdfi grants to sponsor a variety of programs, including small business lending and a resettlement loan program for low-income members. The grants also supported the Whole Again Loan Program, an initiative that provided $17 million in consumer loans to replace goods and vehicles destroyed by Hurricanes Irma and Maria. The two hurricanes were a life-defining moment for many of our members, and we knew that we had to act through no-cost, 0% APR short-term loans, deferment of existing loan payments, elimination of transactional fees, and financial coaching for our members who were dealing with active insurance cases and attempting to rebuild their homes. In 2020, Jetstream launched a multi-pronged COVID-19 emergency relief program that included emergency loans, lines of credit, a 6-month payment deferral, and fee waivers. Consumer loan deferments totaled $10.5 million, and our fee income was reduced by 32%. Additionally, by strictly following CDC guidelines, Jetstream maintained normal operating hours throughout the crisis. Our low-income members are more likely to live in urban heat islands with fewer trees and more pavement, as well as residing in housing with older building materials and appliances. To address these climate-related challenges of our members, we are fortunate to have recently been approved for a Cdfi grant for a green loan program. This will address these challenges with innovative products and underwriting created to improve efficiencies for low-income homeowners and also help those who need major repairs to their homes, resulting in improved housing stock and increased household income. Thanks to the Cdfi fund, we are looking forward to unveiling this program to our community later in 2022. My written testimony outlines a series of steps that can help MDI and Cdfi credit unions continue to serve their communities and members. Some of these include increased funding for the Cdfi fund and the NCUA's Community Development Revolving Loan Fund, creating a Cdfi crisis fund to quickly make capital available to Cdfis to address a crisis, improving and streamlining the process for certification and recertification as a Cdfi, allowing credit unions to serve underserved areas and have longer loan maturities, requiring the FHFA and FHA to establish specialized mortgage loan programs for MDIs and Cdfis, and improving the process for de novo credit unions. In conclusion, MDIs and Cdfis play a vital role for millions of Americans. We urge Congress to support funding for these programs and take steps to make it easier for credit unions to serve their members and communities. Thank you again, Chairman Warnock, Ranking Member Tillis, and the members of the subcommittee for the invitation to testify before you today. I welcome any questions you might have.
Thank you, Ms. Cusey. Next, we will hear from Mr. Griffith, who is in person.
Chair Warnock, Member Tillis, members of the Senate Subcommittee, thank you for the opportunity to testify today. My name is Joel Griffith. I'm a research fellow at the Heritage Foundation. The views I express today are my own and should not be construed as representing any official position of Heritage. Taxpayer dollars diverted to Cdfis and the Cdfi fund all too often hinders competition and misallocates limited economic resources benefiting select interests. In addition, a lack of transparency has yielded lax accountability and has resulted in lost confidence in the fairness of our financial system. The 2021 Emergency Capital Investment Program highlights the elevated risks that dominates Cdfi lending. Congress, in March 2021, authorized the Treasury Department to invest up to $9 billion in Cdfis to enable them to meet capital requirements and to continue lending even as the threat of defaults on loans previously made by Cdfis grew. In just an 8-month span, 1 in 3 Cdfi depositories requested Treasury investment through this emergency program. This suggests that distressed loans threaten the operational capacity of more than 1/3 of the Cdfi depositories. The extent of the demand for taxpayer assistance through this emergency program over the past year underscores the danger stemming from looser underwriting standards, government subsidization of the Cdfi business model, and the lack of transparency. Another troubling component of the new government largesse for Cdfis is the State Small Business Credit Initiative. The American Rescue Plan provided $10 billion to restart this initiative that funds state programs that provide loan guarantees to politically favored entities. Numerous problems have plagued this program in the past. For instance, The Treasury's Office of Inspector General identified non-compliant expenditures related to California's loans, which constitute a, quote, reckless misuse of funds. The Inspector General also identified reckless misuse of funds and conflicts of interest in the New York SSBCI program related to one of the venture capital firms participating. These states were not alone. The Inspector General found only 4 states were in full compliance with this program that funds Cdfis. Although marketed as a pandemic response, SSBCI funding is now available for years into the future, and this basically allows Cdfi funding to operate as a slush fund for politicians across this country. The fact is, government-provided capital is sponsoring political ambitions and padding the pockets of special interests, but it is not filling an unmet funding need of small businesses. The vast majority of small businesses are saying they are generally not looking for more credit. Only 3% of respondents in a January 2022 NFIB survey reported that their borrowing needs were not satisfied. Only 1% of small businesses reported financing as their top business problem late last year. In fact, only 2% of businesses are reporting that their most recent loan is any more difficult to achieve than their last one. Well, favoritism and inefficient allocation of capital is even more of a concern now with Cdfis with the advent of opportunity zones, because Cdfis are now providing below market rate debt to finance investment projects in favored neighborhoods. Unfortunately, research shows that current residents of targeted areas do not see an increase in wages following this development aid, but they do experience rising rental costs. Higher living costs without higher wages result in a lower standard of living in the communities that policymakers are trying to help. And these place-based subsidies have a history of unintended consequences and corruption. In conclusion, state and local governments share a responsibility to eliminate the artificial barriers that prevent economic growth and that limit affordable housing. But this includes minimum wages, occupational licensing, unreasonable zoning restrictions, and of course, the failed public education system, the monopoly that fails millions of students who are subsequently unable to compete in the labor market. In contrast to these specific policies just outlined, more government investment in Cdfis will fail to yield consistent increases in employment, wages, or advances to general economic opportunities. Place-based programs cannot resolve the complicated institutional barriers to economic opportunity. These government-subsidized place-based lending investment fails to address the underlying causes of concentrated poverty. These causes are educational choice, the lack thereof, restrictions on worker freedom, and continued onerous local regulation and mismanagement. Thank you to the subcommittee for your time and the invitation.
Thank you all so much for your testimony. We turn now to questions. We know that not all communities have equal access to small business capital. They simply do not. The institutions we're discussing today are specifically designed to help these rural and underserved parts of our communities. To help protect jobs during COVID-19, Congress passed the Paycheck Protection Program, or PPP, a new forgivable loan program for small businesses. However, when launched, small businesses in underserved communities nationwide discovered that they were shut out of the process. They were at the back of the line. The Shake Shacks of the world were in the front of the line. And these entities were shut out of the process by some of the nation's biggest banks. It was community lenders that stepped up to help. And when the PPP program ended, institutions like Cdfis and MDIs were the ones most likely to reach small businesses in underserved communities, with 77.9% of their loans for under $150,000. Smaller sized loans like these are critical for mom and pop businesses, and so-called micro business loans are especially an important tool that Cdfis and MDIs can use to help their communities. Ms. Cusey, how has Jetstream used these microloans to help your members meet the needs of your community?
Well, we found that access to micro business loans was the largest unfunded financial need in our local community. Whenever I attended Chamber of Commerce meetings or just even feedback from our employees and our membership, members were looking for these loans and they were not able to find them through the banks in the local communities. So we did receive a Cdfi grant, and it helped us fund a very robust business lending program. We offered micro business loans from 10 to 50,000. I can tell you 100% of those loans went to minority borrowers, and almost 50% went to female borrowers. Those loans funded a variety of businesses in our local communities, including professionals such as CPA, real estate agents. We helped launch or expand businesses that were involved in food service, janitorial, mentoring. We have a lot of interesting stories. We had one lady come to us. She had designed and manufactured dancewear, and she wanted a loan to market this dancewear nationwide. We gave her that loan, and almost immediately through the marketing, she obtained the contract for the Miami Heat cheerleaders. And that was such a visible contract that her business expanded exponentially from there. And this was someone that we gave a $20,000 loan to, and she's now a very successful entrepreneur. And I could go on with these stories all day, but I know that there's a clock. So if you have any other questions, I'd be happy to answer them.
No, thank you so much. And that's a wonderful story, but can you tell me what are some other hurdles that still exist between these small and needy borrowers and micro lending services that Congress might still address?
Well, the availability is an issue. There's definitely not a wide availability of these loans, particularly to minority and low-income business borrowers, and the rates and terms are often not favorable. So I would say those are the largest obstacles.
Mr. James, big banks have historically underserved rural areas, but small businesses in these communities face the same capital needs that any small business faces. Would you speak to your experience with Cdfis in helping rural communities and small businesses in Georgia? What difference do they make?
Sure. Thank you very much, Chairman Warnock. Our institutions really focus on all the areas that are underserved. And as you know, in Georgia, that means many swaths of our community that are rural in nature. And so we have taken at Carver, we've taken a special effort to reach out to many of those rural communities, including those with persistent poverty. So for example, we joined up with the city of Statesboro, Georgia, to make a special loan program available to Main Street businesses in Statesboro that were impacted by the pandemic and were not able to get enough funding from the PPP loan program. We have made additional efforts in other rural communities around the state. And so those are just a few examples of how we reach out to rural communities across the state and across the nation.
Thank you so very much for clarifying the role and unique role that these institutions play. Ranking Member Tillis.
Thank you, Mr. Chairman, and again, thanks to all the witnesses. I told the chairman I had them call the vote. I was going to step out, but I wanted to hear your opening testimony, and I have a few questions for you, and then I will move to the next vote that's pending now. But Mr. Griffith, I just wanted to start when you were talking about that survey of businesses and their needs being satisfied. One of the things that I believe that Cdfis and MDIs do are get to people that may never get to that survey. And I have to use a personal example. When back probably 1974, I was pretty good at carpentry and drywall work because my father made a living for 6 kids by doing construction repairs for insurance jobs. So kitchen fire or something, he didn't have the resources to fund even the materials. So what he would do is he had a relationship with a local bank that at that time when banks were able to do more on relationship banking versus some of the regulatory hurdles that have made that very difficult for them to do today, we'd get the money to go to the lumber yard to get the materials, finish the job, and pay it back. Those are businesses of one or two, or in some cases with some of the MDIs and CDFIs, 5 or 6 person businesses, it may not be caught up into the entire need of the community. So I do agree that there are a lot of banking needs that probably can be fulfilled through some of the other members of the ecosystem, but I just intuitively believe that there are fathers and mothers out there like mine that are searching for capital and may have limited options, particularly based on their revenue, their credit history. I'm sure at that time, the Tillis family credit history wasn't that good. So that's more of a statement for you, and if I have time, I'll come back with a question. But Mr. James and Ms. Cusey, first off, have either of you read the Carsley report?
I have not. Cindy.
I have not either.
Okay, well, we'll make sure our staff gets you a copy. So I'm not going to be unfair and ask you to talk about any of the specific findings, but I just intuitively believe that you all probably, given the nature of the relationships you build, I actually work pretty closely with an MDI down in North Carolina when I was Speaker of the House, and I was actually pretty impressed with their portfolio projects. They weren't all successful, but they were more successful than not, and that's the nature of lending. But would you agree that it would be better if we were equipped with information on efficacy, accountability, some of the things that Mr. Griffin mentioned, so that in future committees, we're equipped with data that really instruct us on how to move forward with more of a fact basis for that? Now, I know that when I say that, you're probably rolling your eyes and thinking, oh gosh, that means more reporting and more data. Do you also agree that some of the current reporting and requirements that you have today could be made leaner so that we can grab this information that would be helpful to us to administer the programs over time? And Ms. Cusey, we'll start with you, and then we'll go to Mr. James.
Okay, credit unions are highly regulated, so a lot of that information is available through the requirements that we're reported to the NCUA.
That's actually, Ms. Cusey, I'm sorry to cut you off. I just want to be sensitive to time. I know you have been, but that's true. I'm very familiar with credit unions. But Mr. James, maybe you can chime in and give me your perspective.
Sure. Thank you very much, Ranking Member Tillis. Yes, I would agree that we can streamline and make more efficient all of our reporting requirements as CDFIs and MDIs. Our institutions are similar to Ms. Cusey's, highly regulated. We're federally insured banks, and so we're very, very highly regulated. But I also think that the infusion of new capital into our sector really does provide us with an unprecedented opportunity, not just to make new loans, but also to develop a better infrastructure for capturing and reporting on impact data. And so at the NBA, for example, we've been very intentional over the past year, including creating a new nonprofit arm that has as one of its main pillars the gathering and reporting of impact data from the minority depository institution sector to make sure that we are tracking our impact and reporting it out in a much more useful way. And so we look forward to building out that infrastructure with new resources and being able to report much more data back to all of our stakeholders, including members of Congress.
Yeah, well, thank you for that. And I would just close by saying that I think the chairman and most likely his able staff picked two good witnesses to come before the committee, but we are talking about hundreds of CDFIs and MDIs. And in the banking industry, where I spent most of my career, looking for some of this baseline data is relatively easy to gather. So I'm trying to get at why for the Cusey study and for other ones, it seems to be more difficult. It seems like there's something more that we can do there that ultimately benefits you. And then it either proves or disproves some of the concerns that Mr. Griffith has mentioned in his opening testimony. Mr. Chairman, I am going to go vote. I thank you for holding this hearing, and I thank the witnesses, and I will make sure that my staff gets you a copy of the report. And I'd be interested if you could either submit for the record or informally your feedback on it, what positive or negative. It would be very helpful as we move forward. Thank you, Mr. Chairman.
All right.
Thank you very much, Ranking Member Tillis, for staying and missing the vote to hear their testimony, to engage this important conversation. We're waiting on some other members to come, probably, I'm sure, from the vote. We've gone into the second vote for the afternoon. But as we prepare for them, I'm going to change the topic just a little bit. Last year, over 2 million Georgian children received $300 per month in the expanded child tax credit. This is the largest tax cut for working and middle-class families in American history. Eradicating childhood poverty is an issue that touches me deeply, and championing this tax cut has been one of my proudest moments in the Senate. We really ought to extend it. The expanded child tax credit not only helped give working families in Georgia and across the nation financial stability and peace of mind, but it also boosted the economy for all of us. Unfortunately, last month was the first time since the summer that these monthly checks did not arrive for families in need, the same communities served by these MDIs and Cdfis. Mr. James, community institutions such as your own, Carver State Bank, literally right down the street from where I grew up, are acutely aware of the economic well-being of the communities they serve. What effects did you notice on your customers and your bank customers while the expanded CDC payments were being distributed?
Chairman Warnock, thank you for that question. And you're very familiar, as you stated, with exactly where our bank is located and the community that we serve. We're located in the lowest income census tract in Savannah, and which is where our headquarters is. And that's because there's a high concentration of public housing in that census tract. And so we have a number of customers who maintain accounts with very, very small balances. One of the things that we noticed during the payments that were coming in is that a lot of those customers had a little bit more cushion in their accounts. We didn't have to spend as much time helping people monitor and make sure that they didn't have overdrafts, for example. We saw that there was fewer instances where people didn't have the ability to make certain basic payments. And so we applauded the influx of capital to many of those customers who are, at the lowest end of the spectrum in the local Savannah community. And we think that those additional funds were certainly very beneficial to them as they sought to make ends meet for all of their everyday needs.
Thank you so much, and I will continue to fight to make this expanded child tax credit permanent. Looks like we're still waiting on other members. Last year, to provide pandemic relief, Congress provided $12 billion in capital investments and grants to Cdfis and MDIs to support their efforts in low-income and minority communities. These federal capital investments will help fund loans for communities who face barriers when accessing capital and will be used to leverage private funding to amplify the transformational effects the funds will have on communities. Mr. James, again, how important are these capital investments and grant programs to ensure underserved communities continue to get the support they typically receive from Cdfis and MDIs?
Mr. Chairman, these capital programs have a historic, we have a historic opportunity with these capital programs to make an incredible difference that is long lasting and in these communities that are so underserved and have been chronically underserved. As you mentioned, there were $12 billion that were allocated. Only $1.2 billion of those funds have actually been distributed so far. The remaining $9 billion in the ESIP program has been earmarked but not distributed yet. And the remaining dollars are at the Cdfi fund awaiting their development of a new program for institutions that focus on minority lending. I just want to emphasize that our institutions are focused on expanding not only our scale of lending, but also building and improving on our infrastructure so that we can be more efficient and get these needed loans and services out to communities in need in a much more efficient way. And so at Carver, for example, we're focusing on building our technology capabilities and being able to reach out, not just in the Savannah community, but across the state of Georgia. By having better technology, we'll be able to reach into those rural communities with much more efficiency and be able to provide services such as the kind of small business lending, home ownership opportunities, community development lending, and other kinds of services and products that are so critically needed.
Thank you so very much, Mr. James. Senator Warren has arrived.
Thank you, Mr. Chairman. And let me start by saying thank you very much, Mr. Chairman, for holding this hearing. Community development financial institutions and minority depository institutions provide a range of critical supports to underserved communities. They do everything from ensuring that families have access to basic financial services to fostering small business creation and being on the front lines of emergency relief when disaster strikes. So I want to talk about, though, another area where Cdfis and MDIs play a key role, and that is in promoting the supply of safe and affordable housing in communities that need it most. That is, in low and moderate income neighborhoods, in communities of color, and on tribal lands. Our country is facing an historic housing crisis, with the impact falling hardest on low-income families and communities of color. I have one stat on this that just knocks me over. About 60% of very low-income renter households and nearly 30% of Black renter households are putting more than half their income toward rent. So, Mr. James, if I could, I'd like to start with you. You have decades of experience in community development, including promoting affordable housing in Savannah. So let me ask you, just a hypothetical here. If a developer wants to fund new construction or the rehabilitation of existing housing units in a low-income minority or native community, is it easy for that developer to get traditional financing to fund an investment in affordable housing? What do you say, Mr. James?
Thank you for the question, Senator Warren. Unfortunately, the answer is no. It is not easy. Even in smaller urban markets like Savannah or in the rural markets surrounding us in southeastern Georgia, it is extremely difficult to make traditional loans to finance affordable housing development without some sort of subsidy. In urban markets, skyrocketing land costs and compliance with development regulations and standards, and just the overall high demand for new housing makes it very difficult for developers to create affordable product. In rural markets, the high cost of construction are having a similar effect. And we're not just talking about housing for low-income people. We're talking about teachers, firefighters, police, and even those with middle incomes that are increasingly unable to afford rents, much less home ownership. So we do need to see more programs and products that would allow us to be able to effectively make loans for those kinds of developments.
So I appreciate that. Thank you very much for your expert opinion on that, Mr. James. So here we have families who need housing, and you've got developers who may want to provide that housing, but it's hard for them to be able to reach traditional funding sources. We all know that one of the tools that Congress has to support Cdfis in expanding the supply of housing in financially underserved communities is the Capital Magnet Fund, which provides grants to Cdfis and nonprofit organizations in order to spur investment in affordable housing. The idea is to bridge the gap between what traditional financing would provide and what it is that these communities need. My American Housing and Economic Mobility Act would invest $25 billion in the Capital Magnet Fund over 10 years. An investment, just to put that in some perspective, that is about 30 times larger than the total amount of awards the fund has made up to now. In other words, a whole lot more money. According to an independent analysis, this investment, which would be leveraged 10 to 1 with private capital, would fund the construction of about 770,000 new affordable housing units. So a real way to get something done. Mr. James, can I ask, in your view, what would an investment of this size in the Capital Magnet Fund mean for housing markets and for families in underserved communities and communities of color all around our country?
Thank you again for that question, Senator Warren. The legislation that you're proposing would help us achieve a scale of investment that matches the scale of the problem. This legislation would provide Cdfis with critical resources that would allow us to increase the velocity and volume of financing for affordable housing. In most communities around the country, housing demand is, again, far outstripping supply, and we just don't have enough resources. And so we can be a part of that solution if we have more resources to support affordable housing. So we would definitely support legislation of this type.
Well, that's a good partnership. Let's see what we can do on this, Mr. James. You know, for CDFIs in Massachusetts, like One United Bank and Worcester Community Housing Resources, increased access to funding that supports the construction and rehabilitation of high-quality, affordable housing could help bring down rents and open the door to home ownership for thousands of families. We need to use every tool we have to address the affordable housing crisis that is worsening by the day. By leveraging close relationships that they have on the ground to ensure that communities are getting the resources they need, CDFIs and MDIs are able to bring capital to people and to places where traditional financial institutions either can't go or won't go. Ramping up investments in these institutions in the Capital Magnet Fund to expand the supply of safe, affordable housing in communities that are feeling the crunch most acutely is a tool we just can't afford to ignore. So, Mr. James, I appreciate your offer of partnership. I sure hope we can get this done. And with that, I want to call on Senator Menendez. Our chairman has had to go vote. So, Senator Menendez, it's up to me to recognize you for your questions.
Thank you, Senator Warren. Good afternoon, everyone. Throughout the pandemic, we saw that minority and women-owned small businesses were hit particularly hard. And at the same time, we saw that the vast majority of funding under the Paycheck Protection Program went not to these businesses that were most affected, but to predominantly white-owned businesses with pre-existing relationships with banks. So I know that you all worked pretty hard at trying to meet that challenge, but what lessons did you learn from the pandemic that can be brought forward to mitigate disproportionate harm to minority and women-owned businesses in the future? And
Well,
invite either one of you.
I definitely think that providing ongoing funding to these businesses, and I earlier talked about our micro business loan program, where we offered $10,000 to $50,000 loans in our community to minority and low-income business owners. And through the various catastrophes, Hurricanes Irma, Maria, the COVID pandemic, we've been working very closely with those businesses, and we've been offering payment deferrals, loan restructures, additional loans, and also counseling and advice. So I think it's being a close partner in good times and bad times.
Mr. James, any insights?
Senator Menendez, thank you. It's an excellent question. We learned quite a few lessons at my bank, Carver State Bank in Savannah, as well as across the National Bankers Association. One of the lessons that we learned is that our institutions really needed to scale up. We need more capital so that we can invest in technology and people, so that we can be ready to meet a crisis when it happens, but also to be ready to deploy more capital in these communities to make them more resilient, so that they can withstand the crisis before it comes. So, for example, our institution will be using ESIP dollars to partner with a fintech company to make consumer loan products that are safe, effective, and low cost available to communities that are subject to predation from title pawn lenders and others in the state of Georgia that take advantage of communities. We also want to be able to automate the small business lending process and make it much more efficient so that we can make more small business dollars available in communities across the state, not just in the Savannah market. The other lesson that I learned from it was just personal, that many of the minority businesses that we were able to help, our bank made probably 90% of our loans to minority-owned businesses, but some of them came from outside of our market, well outside. People who were in California or New York who found us online and were able to get a PPP loan, even when they had a bank account at another bank, but their large bank wasn't prioritizing their loan application. And so those are the kinds of lessons that we learned, that we need more capital so that we can scale, and we need to be able to reach out to those communities and people who are underserved.
Thank you for those are great insights. With climate change causing more frequent and more intense natural disasters, small businesses face unprecedented risk to their operations. Furthermore, low-income and minority communities have been found to be more likely to face the impacts of these natural disasters. In the aftermath of Hurricane Sandy, New Jersey Community Capital, a Cdfi in my state, raised $3 million in lending capital in a matter of weeks and provided small businesses with flexible, low-interest loans to help recover from the storm, resulting in over 100 jobs that were saved. Just one example. Ms. Cusey, in what role should Cdfis have in helping small businesses and communities recover from natural disasters? And how have MDIs played a role in disaster recovery in Puerto Rico, particularly after Hurricane Maria?
Well, we were the first credit union to reopen in Puerto Rico after the hurricane, so that really enabled us to help a lot of people. We knew it was a life-defining moment for many of our members, and we knew that we had to act fast, and we did that through offering no-cost 0% APR short-term loans, deferment of existing loan payments, elimination of transactional fees, and financial coaching for our members who were dealing with active insurance cases and attempting to rebuild their homes. We also provided $17 million in loans to assist people enable them to replace household appliances, furniture, and autos. And after the hurricane, we actually had a very unique program where we assisted Puerto Ricans that were moving from the mainland. And we assisted them in transporting their vehicles and coming up with first and last month rent and rental deposit, which is, as you can imagine, quite high in Miami. So we offered a variety of programs to get them through and help them recover after the hurricane.
I see. I see my colleague, Senator Tester. I don't know if he's had a chance to ask his questions yet, but if not, I'll yield to him.
Thank you, Senator Menendez. It's my responsibility to call on Senator Tester now. Thank you. Senator Tester?
Thank you.
Well, thank you, Senator Menendez and Senator Warren. It's great to get doubly recognized today. And I want to thank the panelists for being here. Look, Cdfis and NBIs in my state of Montana have provided critical resources for communities all across our state. Their efforts have been tireless and persistent, and it's allowed our Main Street business to access the Paycheck Protection Program as this pandemic started. And I want to tell you, a comment was made previously, I think by Mr. James. The work that the Cdfis did in our state to get this Paycheck Protection Program money out, where big banks could have cared less, it was stellar. And I want to thank you for that. But they also help us in home ownership, down payment assistance programs that allow Montana families to realize the dream of home ownership, to piecing together their financing for new and improved community facilities. The small community folks' nature of these institutions is a part of what makes their work so impactful, but it also can mean that it's harder for folks to get access or even know about these great resources. So, Mr. James, From your work in the industry, are there barriers to the growth and scale necessary to reach more of the folks in your community left out of financial mainstream?
Thank you, Senator Tester. The short answer is yes, there are barriers. The biggest one, in my estimation, in particular for the MDIs, is lack of scale, and that lack of scale is due to a lack of capital. And in particular, in the African American community, our institutions have had a very historic, long standing lack of access to the traditional capital markets, which has constrained our ability to grow and be able to reach deep into the community to make sure that they have access to mainstream financial services. So that's one of the reasons why we're so enthusiastic about the ESIP program, which is going to put some historic amounts of capital at play in our sector. But I do want to make sure that I point out that many of our institutions were unable to access ESIP because of an unfortunate situation in regards to how regulation gets applied to many of our institutions. So our banks are regulated just like every other bank. We're FDIC insured, and so we have to be regulated by either the OCC or the FDIC. And those regulatory bodies are under a congressional mandate from the Financial Institutions Recovery and Reinforcement Act of 1989, or FIREA. In Section 308 of that act, it says that the regulators and the Department of Treasury and the Federal Reserve have an obligation to preserve and promote MDIs. Yet since 2008, over half of the Black-owned banks have failed. And what we've found is that there's an uneven application of regulation when it comes to our supervisory authorities that don't take into account the mission that we provide in the specialized business models that we have to use in order to serve underserved communities. And so one of the things that we'd like to see is a revisiting of how our institutions are regulated, not to make them less safe or sound, but just to take into account the fact that we are banking people who are harder to reach, who have less resources, and are harder to serve, so that we can be able to keep more MDIs around and alive, so that we can access more capital and provide more services to these communities that are so desperately in need.
Thank you for that. Thank you for that answer, and answered my second question almost. Ms. Cusey, are there similar barriers that you've seen in the credit union world?
I'm sorry, could you repeat that question?
Are there similar barriers that you've seen in the credit union world?
Well, we're not able to raise money through the capital markets. There's no secondary capital or subordinated debt. So, I know that is a challenge to many credit unions.
Okay, and for both of you, is one of the barriers that you've seen that Americans simply don't know about Cdfis? Go ahead.
I mean, that is possible, definitely. I'm sure Mr. James the same. We're involved in quite a bit of outreach to get the word out there.
Yes, I agree. I mean, there's a lot of outreach, but I do think that we can make the public much more aware of what we're doing and the services that we provide. And so, but again, that goes back to scale and the ability to, engage in this kind of marketing campaigns that are necessary to kind of make sure that people are aware of what we're doing. We do a lot of this on a one-on-one basis, and it's relationship based. And we don't want to ever lose that. But every time I turn on the TV and I see an ad for a new neobank or digital, sort of bank replacement fintech company, I think about the fact that they are kind of targeting a lot of the same communities that we want to serve, and we want to make sure that we're able to give those communities fair and responsibly priced products, in addition to a slick marketing campaign.
Well, I just want to thank you both for what you do, and I appreciate you being in front of the committee today, and hopefully we can continue this conversation moving forward, because I think you're an incredibly important resource to have out there for folks to really allow our Main Street businesses and families to thrive. With that, I'll kick it back to you, Senator Warren.
Thank you so very much. Our chairman of this committee, Senator Brown.
Well, thank you, Mr. Chair. And a couple of first comments I'd like to say. Thank you, Mr. James, for your support of fellow Georgian, Lisa Cook, for the Federal Reserve. It's one of the president's outstanding appointments, and one that I would credit your senator with helping to encourage the president. They call our role in nominations. The president does the nominations, but we advise and consent. And let's just say that your senator, Mr. James, your senator did a lot of advising to the president on this for the banker, not the banker, the economist from Milledgeville, Georgia. And so thank you for weighing in, and thanks for what you do with the National Bankers Association too. And one other comment, then I just have one question. I'm so appreciative of Senator Warnock as the chair of the subcommittee. The Democrats have been in control of this committee, been chairing this committee and other committees, large part because of his victory and the other Georgia senator. But one of the things I've really liked watching is our subcommittee chairs on this committee, subcommittees that weren't very active in the past, have become very active. This is Senator Warnock's second hearing, first one this year. Senator Warren, Senator Smith, Senator Menendez, and Senator Warner have all understand the role of subcommittees, and it makes this place run better. So thank you for that. And thanks to the witnesses on the importance of the critical importance of CDFIs and MDIs. So my question, Mr. James, is for you. I'll just have one question. I know Senator Warnock's doing many things today. Mission-based lenders like yours are often the best and sometimes the only option for workers to get basic financial services, and for small business and underserved communities to get the funding they need to start or expand their businesses. It's what I hear from MDIs and CDFIs, and I hear that from communities in Ohio. In Build Back Better, we include additional funds, investments for CDFIs to support affordable housing and investments. You've touched on those issues with my colleagues. What will happen? Walk through what happens if we're successful with Build Back Better and doing more investments in CDFIs and MDIs. What does it mean to Carver Financial? What does it mean nationally with the way you look at things from the National Bankers Association perspective?
Chairman Brown, thank you so much for the question, and thank you for your support and comments regarding Dr. Cook and Senator Warnock. Yes. In response to your question, what I see is with both the ESIP program, the infrastructure package, and with the proposed Build Back Better legislation, really a virtuous cycle where we can not only strengthen the institutions, but also much more importantly, strengthen the communities that we serve and make them much more resilient. And so, for example, if we can connect the dots between the capital that's coming into our sector through ESIP and the dollars that are going to be invested in America's infrastructure, and make sure that not only our banks have an opportunity to provide financing where it's needed on infrastructure projects that are to rebuild communities that oftentimes were destroyed by the way that infrastructure in America has been placed over many decades, but also put people to work, put minority-owned businesses to work, rebuilding that infrastructure, doing new things like placing EV charging stations in communities of color across the country, and let our banks be the financing entities for that. If we can connect all those dots, we really, lift the entire economy. We help to reduce the racial wealth gap. We can reduce the home ownership gap. We can create long-lasting job opportunities for everyone, and have the kind of environmental impacts and overall health impacts that we would like to see. And so that's what I sort of envision if we're able to see all of these different pieces come together, not just in words, but also with action and intentionality.
Thank you so very much, Chairman Brown, and thanks to all of our witnesses. Thank you, Mr. James, Ms. Cusey, Mr. Griffith, for sharing your important perspective here today. It was particularly poignant for me to hear, even as Mr. James made his closing statement, talk about the work being done by the Cdfi, that's Carver Savings Bank, literally sits in the kind of community that he described, communities that have literally been split in two. Federal public policy makes a difference, sometimes positively, negatively. That bank sits near Interstate 16, which literally split a historic black community in two, putting people on the other side, literally, of prosperity. This is something that this committee's also tried to, is focused on addressing as we talk about reconnecting communities. That bill that seeks to address that. And it's right there that Cdfi, like others, are doing their work. Similarly, Citizens Trust Bank near my church, near a community split in two in the name of urban renewal at a different time in America. And so these banks are responding to disinvestment over a long period of time. And so I'm grateful for all of our witnesses for taking the time to be with us today and for providing your testimony. Today's hearing highlighted how important these institutions are in helping families and small businesses and communities to prepare, survive, and recover from crisis. And I look forward to working with my colleagues on both sides of the aisle to continue to ensure that they have adequate resources to achieve their mission of helping the underserved. I'm grateful for Ranking Member Tillis's comments. We certainly are not adverse to transparency, accountability, getting the kind of data that we need in order to make these institutions as effective as possible. And as I said at the onset, this topic is about creating an economy that works for all Americans and about ensuring that hardworking families aren't swindled out of a shot at financial stability. For senators who wish to submit questions for the record, those questions are due 1 week from today. That's Wednesday, February 16th. For our witnesses, you have 45 days to respond to any questions. Thank you again, and with that, this hearing is adjourned.